In 1998, a small report from the Asian Development Bank noted something unusual. Several countries that had just lived through the Asian financial crisis were already showing signs of life. Their growth numbers were not dramatic. They were steady, quiet, almost unremarkable. But they were rising faster than analysts expected. That same pattern has appeared many times since then. After the 2008 collapse, after the 2011 supply chain shock, after the 2020 pandemic, Asia recovered sooner. Asia stabilized earlier, Asia learned faster. And the rest of the world often seems surprised by it. One reason sits in a simple observation. When a region builds its economic base around factories, trade routes, ports, and long-standing family-owned businesses, recovery starts from the ground up. People go back to work. Goods start moving. Savings get used. Communities rebuild. It is not glamorous. It is not the kind of story that makes headlines. But it creates a slow and reliable rebound that many Western economists reportedly overlooked. This matters because the world is entering another period of uncertainty. Debt levels are rising. Supply chains are shifting. Energy systems are being rebuilt. And millions of people are watching the changes with a quiet concern. They want to know who will adapt fastest, who will stabilize first, and who has the structures in place to weather the next shock. I remember a shopkeeper in Kuala Lumpur who reopened his small electronics stall just weeks after a major flood. His shelves were still damp. His tools were still rusted, but he had customers waiting at the door. He smiled and said he had no choice. Life had to continue. That mindset appears across Asia more often than any chart can show. So the question becomes simple. Why does this region rebound when others hesitate? And the deeper story begins with a quiet pattern that most people never noticed. The real beginning of this story does not start with a crisis. It starts with a set of choices made decades earlier. During the 1960s and 1970s, many Asian governments focused on building practical foundations rather than chasing quick prosperity. They invested in ports in Singapore, industrial zones in South Korea, special economic areas in China, and export training programs in Taiwan and Malaysia. According to archived records, these decisions were viewed as slow and conservative at the time. But they created a base that could bend without breaking. Most people today remember the big headlines: currency crashes, oil shocks, trade disputes. But the smaller details are easier to miss. In the early 1970s, a Japanese steel company quietly partnered with a South Korean firm to train local workers. It was not a major event, it did not make front-page news. Yet it sparked a shift in manufacturing skills across the region. Those workers passed their knowledge to new workers. Those factories trained new factories. A chain reaction began that very few economists reportedly tracked. The overlooked detail is simple. Asia did not just grow, it learned how to rebuild. Every downturn became a training ground. Every shock became a lesson. A retired engineer from Osaka once told me that the region's strength came from habit. He said people were used to adjusting. When a machine broke, they fixed it. When a supplier failed, they found another. When markets fell, they waited and rebuilt quietly. What part of that early foundation do you think most people overlook today? And as this story moves forward, a more noticeable shift begins to take shape. The first real shift in power appeared in the early 2000s. This was the period when global manufacturing began moving at a scale not seen before. China joined the World Trade Organization in 2001. Vietnam opened new industrial zones between 2003 and 2007. India expanded its service sector with millions of new workers. And Southeast Asia strengthened its role in electronics and machinery. Trade numbers rose sharply. Export volumes from the region doubled within a decade according to archived trade reports. Factories grew, ports expanded, and a quiet competitive edge formed almost out of view. Insiders reportedly noticed something else. While many Western economies were focusing on consumption and financial assets, Asia was focusing on production. This meant that when shocks arrived, the region had something tangible to restart. A port can reopen. A factory can resume. A supply line can reroute. These systems respond faster than financial markets because they are built on daily routines rather than forecasts. A small business owner in Ho Chi Minh City once explained this during a downturn. He said that if orders slowed, he would find new customers. If shipments were delayed, he would call every supplier he knew. Waiting was not an option. This mindset gave the region a practical resilience that larger economies often underestimated. Do you remember a moment when you saw a country bounce back faster than expected? As this shift continued, it laid the groundwork for a deeper mechanism that many people never fully explored. The hidden mechanism behind Asia's fast recoveries rests on a simple structure. Many economies in the region built their systems around networks rather than individual institutions. Factories relied on clusters of suppliers. Ports connected to dozens of regional trade routes. Families supported small businesses through informal lending circles that had existed for generations. And governments often coordinated long-term plans with a focus on infrastructure and exports rather than short cycles of growth. According to archived planning documents from the 1980s and 1990s, this approach was deliberate. Leaders in countries like South Korea, Singapore, and later China believed that broad ecosystems were stronger than isolated champions. If one company failed, the entire system would not collapse. If one route stalled, others could absorb the pressure. If one region suffered a shock, another could rebuild faster. This gave Asia a flexibility that did not rely on a single point of stability. A clear illustration came during the 2011 supply chain disruptions. Manufacturers in Japan lost access to several critical components. Yet within days, smaller plants in Taiwan, Thailand, and Malaysia reportedly stepped in to fill temporary gaps. Output did not vanish, it shifted. And this ability to shift quietly is one of the region's most overlooked strengths. I once heard an electronics supervisor in Penang explain how his team handled shortages. He said they never waited for permission. They adjusted their designs. They contacted every partner they knew. They built temporary fixes until the normal supply returned. He said it was simply how things were done. Have you ever noticed how some communities adapt faster when they act together rather than alone? Understanding this mechanism makes the next part of the story easier to see because it led to changes nobody fully anticipated at the time. The consequence nobody expected appeared slowly. It did not show up in the major headlines. It appeared in trade logs, shipping records, and a few early reports from regional banks. These documents showed that after each crisis, Asia was not just recovering. It was expanding its share of global production. In 1990, the region accounted for less than a third of world manufacturing output. By the early 2020s, that number had risen to more than half according to international industry estimates. This shift happened step by step, often unnoticed by those outside the region. Insiders allegedly described these moments as quiet turning points. They said that every slowdown pushed companies to become more efficient. Every shock forced supply lines to diversify. And every recovery left the region stronger than before. The pattern repeated so consistently that some analysts began calling it the resilience dividend, though the term never gained much traction in the mainstream. For ordinary people, the change felt more personal. A teacher in Manila told me that after the 2008 crisis, her school reopened before most expected. Parents brought their children back. Shops around the campus reopened. Her community slowly returned to its routines. She said it was not confidence, it was necessity. People could not afford to pause their lives. Why do you think these everyday responses rarely make it into economic discussions? This gradual transformation set the stage for a much larger escalation that reshaped the global balance in the following years. The escalation began when global tensions started reshaping trade routes. Several major economies introduced new tariffs after 2018. Energy markets shifted as supply from traditional regions became less predictable. And digital technologies created new demand for chips, batteries, and rare materials. Asia already had the factories. It already had the ports. And it already had the labor force trained through decades of steady investment. So when the world needed faster production, the region became the first place companies turned to. According to regional export data, chip shipments from Taiwan surged. Battery component output in China and South Korea rose sharply. Vietnam, Malaysia, Thailand, and Indonesia expanded their roles in electronics and automotive supply chains. Trade numbers climbed even when global uncertainty increased. This gave Asia an unusual position. While many economies slowed, the region accelerated. Insiders reportedly noticed another detail. Large multinational firms began quietly diversifying within Asia rather than moving out of it. A company might shift part of its production from China to Vietnam, or from Japan to Malaysia, or from South Korea to Indonesia, but the operations stayed inside the region. This kept capital flows stable and allowed supply chains to adapt without major disruptions. A friend who works in logistics in Singapore once told me that his busiest months were often the ones following global turmoil. Ships rerouted, containers shuffled, warehouses filled. He said the region always found a way to keep goods moving because stopping was never an option. Have you noticed how quickly global companies adjust their operations when they see Asia stabilizing? All of this momentum pushed the system toward a critical moment that many analysts did not fully anticipate. The breaking point surfaced when multiple pressures converged at the same time. Energy prices rose. Shipping costs climbed. And several Western economies struggled with inflation that lingered longer than expected. Meanwhile, Asia kept producing. Factories in China, Vietnam, and South Korea maintained output. Ports in Singapore and Bizen handled record volumes. And regional trade agreements created smoother pathways for goods to move across borders. This contrast made the imbalance impossible to ignore. Archived briefings from trade ministries described a moment when demand for Asian goods surged beyond earlier projections. Companies reportedly stopped asking when the world would stabilize. They asked how quickly Asia could increase capacity. This shift in tone marked a real crack in the system. It showed that the world had become dependent on a recovery model that only one region consistently delivered. A warehouse manager in Shenzhen recalled the turning point clearly. He said his team received orders that were supposed to be spread across 3 countries. Instead, all of them arrived together. Customers wanted certainty. They trusted the region's ability to deliver. He said the pressure was immense but familiar. They had seen this pattern before. At moments like this, it becomes natural to wonder what held the system together and why the same pattern kept returning. The underlying answer forms a quiet but powerful thread that ties this entire story together. The hidden pattern becomes clear when you step back and look at the last 50 years. Asia's recoveries have never been accidents. They follow a structure that repeats across decades. A shock arrives, output drops. Communities adjust quickly, factories shift their orders. Governments stabilize the essentials. And within months, the region begins building again? The same sequence appeared after the oil shocks of the 1970s. It appeared after the 1997 currency crisis. It appeared after the 2008 collapse. And it appeared after the 2020 pandemic. Different events, same response. Historical parallels make this pattern easier to see. Japan used this method to rebuild its manufacturing base during the 1950s and 1960s. South Korea followed a similar path in the 1970s and 1980s. Taiwan, Singapore, and Malaysia built their export models through the same slow and practical steps. Even China's rise from the 1990s to the 2010s matches this rhythm. Each country focused on resilience first. Competitiveness came later. The world often noticed the second part and overlooked the first. I once heard a trade consultant in Hong Kong explain it simply. He said the region does not fear disruption. It expects it. That expectation creates a culture where preparation is routine and rebuilding is almost instinctive. Do you think this pattern emerged by design or by necessity? Understanding this long arc helps explain why Asia's role today feels different from earlier eras. Because the consequences now stretch far beyond the region itself.